Cash flow. This B Business B video is going to look at the topic of cash flow, what it means and how you calculate it. Cash flow is the inflows and outflows of money that go into a business. Typically, inflows is money going into a business such as sales revenue, the owner's investment or a bank loan. Whereas outflows would be wages, cost of sales and utilities. So any money that comes into the business bank account is seen as an inflow, and any money that goes out of the business bank account is seen as an outflow. So we know that cash flow is the inflows and outflows of money in a business. But a cash flow forecast is a prediction of the inflows and outflows of money in a business. Prediction is the key word. Just think about forecast like a weather forecast. Cash flow statement will be the actual inflows of money out of a business because it's a fact. It's what's actually happened. So there's your difference between a cash flow forecast and a cash flow statement. As you can see, here's an example of a cash flow statement. What you have is some key terms. The opening balance is the amount of money that you have in your bank account at the start of each month. So for a new business, it's always assumed to be zero, unless you're told otherwise. You then have your inflows and your outflows. And we have something called net monthly. Now, net monthly is effectively the profit you make in each month. It's your inflows minus your outflows. And finally, you have your closing balance. Now, your closing balance is the amount of money that's in your bank account at the end of each month. The way you'd work this out is by adding your net monthly to your opening balance. So if you had nothing in your bank account at the start of January and you've now made £200 in that month of January, then your closing balance will be £200. That £200 for the closing balance of January will then move to the opening balance of February because the first of the month follows on from the last day of the month previously. Very simple. However, let's look at an example where I'll calculate this with you. Here is a simple question that we're going to use for this example. So B has the following sales information. You've got January's, February's and March's sales or inflows, and you've got B's expenses for January, February and March. And you need to use that information to complete the cash flow statement below. I've also annotated what formulas I'll use at each point so you can see how I'm calculating this. We're going to start with an opening balance of zero because it's a new business for B. So firstly we have our inflows of £500 in January. And we now have our outflows of £300 in January. Our net monthly is calculated by doing 500 take away 300, which is 200. And that means that we now have £200 as our closing balance because nothing at the start plus 200 is 200. Remember, our 200 from the closing balance moves to our opening balance for February. As you can see, our inflows are £300 and we have £350 going out. And this gives us a net loss of £50. Notice a loss is in brackets. Now, of course, we actually only have £150 in our closing balance because 200 plus minus 50 is 150. And that moves up to our new opening balance. Now we have to enter our new figure of £600 and we have £200 going out, and that gives us a net monthly of £400. And that also gives us a closing balance of £550, and that's your cash flow completed. Finally, to finish off with, I just want to look at what can we interpret from the information we've got in our cash flow forecast. Well, firstly, we can say that the business has a positive liquidity position because the closing balance always remains above zero. Remember, if the closing balance was to go below zero and into a negative, it would mean that the company would need to arrange some form of short-term borrowing. That could be typically seen as an overdraft, but overdrafts come with a high interest rate and can be expensive. Of course, that also increases your outflows because you have to pay back the interest, and the interest would be money going out of your business. But in this case, everything is positive. Apart from, you will notice the net monthly in February is a negative figure of minus 50. Remember, negatives are always in brackets. So the question you may be asked in an exam is, what could the business do? Or what should it take from the interpretation of the data? Well, it could increase its inflows, i.e. sell more products, or maybe the owner could invest some money, or it could arrange a loan. Or maybe it could look to reduce its outflows, find a cheaper supplier, use less resources, or it could try and arrange credit. Now, credit is when you get time to pay. I will look in another video in more detail at how this impacts on a cash flow position. But imagine if you could pay your suppliers a month later, and if you look at our example there, we have £400 net monthly profit previously. So you could shunt your payments along 1 month, and actually you wouldn't have any month where you have a negative position. But it's not really a problem with this business because it never has a closing balance as a negative. I will look in more detail at how you can adjust payments to manage your cash flow position and other strategies you can take in another video. Hopefully you now understand what is meant by cash flow. You can explain the difference between a cash flow statement and a cash flow forecast, and you can calculate a cash flow statement or forecast. If you can do all of that, then fantastic, you understand the basics of cash flow, and you're now able to move on and look at how payments can be adjusted, and you can manage cash flow position to ensure that a business has a more substantial and positive liquidity position.